All right. We are back live every Monday at 3 p.m. Pacific Standard Time, answering any and all your mortgage questions, real estate questions. Just a mortgage broker who likes to talk on YouTube, giving you my insight of what I'm hearing, seeing, and feeling, talking to dozens of real estate agents each and every week, talking to hundreds of consumers each and every month, and bringing you what I'm seeing and feeling in my market and other markets across the U.S. because we are licensed in 48 states. If you want to connect with me and my team, get yourself pre-approved, find out exactly what you qualify for, and more importantly, what those numbers look like on a monthly budget basis. Go to greatmortgagebroker.com, fill out the form, let us know where you're at, how we can help. We'll be in contact very shortly. 24 hours is our service level agreement. It'll probably be sooner. We'd like to get back to folks relatively quickly. So this week, I'm looking at, another big uptick in inventory, not just in my market in Sacramento, California, but in many markets across the U.S. Up 6.2%. Active listings is something I think is more important to look at rather than, the overall number of homes on the market. Because if they're in contract, they're not active and you can actually buy them, what good are they really, right? So active listings, available inventory, another way of putting it, up 6.2% to 444,000 and some change. You got to realize, although we've seen a drastic uptick in inventory, that's still like half of what would be considered normal, right? We need to get to about 1 million homes of active inventory for us to be considered a normal market. The guys over at Altos Research that do a great job. They interviewed Logan from Housing Wire. He thinks that we might be up to those 1 million homes of active inventory by middle of next summer, which is probably faster than most people think that we can get back there, right? Because there's no event that's going to happen that we're going to see a couple 100,000 more listings in a short period of time. But I think Logan, one, he's a lot smarter than me. He may be onto something. In order to get to 1 million active listings, you don't have to have a humongous uptick in what gets listed. What you could have is an uptick there, but also a real big draw on how much stuff gets purchased, right? If we're seeing things get into contract less frequent or less fast, however you want to put that, that's going to add to the active inventory, right? If a half of the homes that were listed, say in 2021, sold within 7 days and they were off the market, right? No longer active inventory. There was never any chance for inventory to build. If, and I say if, but it's happening, things are selling at a slower pace, that's one way that inventory is going to build. Another good stat from the folks over there at Altos Research, they track how many homes are considered immediate sales, selling within the first couple of days of being listed. This week, that number was like 20,000, which was the lowest number since February. And the percentage wise of how many, new listings were immediately being purchased, and bought within that first day or two, down to 19.7%. During the heyday, that number was in the mid 30s, I believe. 1 in 3 houses being in contract within the first 2 days of being listed. So we know inventory's up. We know things aren't selling as fast. And there's more and more price cuts, right? The latest stat on price cuts was, is my camera acting funky? Is that just me? Let's go to a different setting. Maybe that'll be better. Besides things not selling as fast, inventory rising, partly due to because things aren't selling so fast, we've also got more price cuts than we've seen in a long time. I think price cuts across the board are like 29% of active homes have at least one price reduction. We're going to tip over 30%, just the trajectory of how things are going. It'll be the first time that we've seen over 30% of active homes with a price cut since Christmas of 2019. So thanks to Altos Research. Some of those stats came from them. They do a great job. So check out altosresearch.com. I got a paid subscription to them, so I'm getting more and more of their data because it's good stuff consolidated all in one spot. Yep, I agree with you. Just read this one, Ryan, and I totally agree that we're going to have more and more inventory just because the stuff that comes on doesn't sell as fast. So it starts to stack on each other where, you would not see something in Sacramento on the market for 47 days or 34 days or even 22 days. And now I see the stuff all over the place. Besides the new stuff that's coming on, there's something that's been there for 3 weeks, something that's been there for 4 or 5 weeks. And it's not all markets. It's not all price points. It's not everywhere. But if you're not priced correctly, if your home doesn't show well, like I see stuff all the time. I saw something come on the market recently, and I just thought to myself, that thing has no chance of selling at 630. At current condition, based on everything I know about the neighborhood that it got listed in, they should have priced it in the mid 5s. So they're way the heck off. Maybe they fell asleep in February and just woke up and threw it on without checking back in with the real estate market. But we're in a different market. You can't price that thing at 630 and expect it to sell. And I agree with you, Ryan. Waning demand. I ran some numbers for somebody, and I think folks would be interested in this. If you haven't got loan scenarios, let me see if I could pull these up. Recently, at today's rates, you would be shocked, I think. And a lot of folks who might be in a home, they've lived in for a while, they take for granted that they have a $2,000 mortgage or an $1,800 mortgage. Nowadays, in a market where your average price point might be $500,000 or above, let me see. Let's see if I can find this, because I put together a $525,000 purchase, 3%, 5%, 10%, and 20% down. There it is. And I think people would be absolutely shocked at what those payments look like. Knowing that like 500,000 is relatively entry level in my market. I understand that's not all markets, but in Sacramento, at least, 5% down at 525 is kind of what the average millennial first-time buyer is going to be able to do. And I can tell you 3% down with great credit and a 5.375 interest rate, which we've got access to the best rates being brokers. Your total monthly payment on a 525 purchase with 3% down is still close to $3,700. I don't know about you, but when I talk to somebody who's in their, mid 20s or even in their 30s, and we're talking about a $3,700 a month mortgage payment, plus water and sewer, plus the SUD bill, plus all the other bills, that's a pretty scary proposition. And so I don't blame folks. If I take this 5.375 and I go 3.375, the payment is still $3,000 a month, but 3681 per near $3,700 a month between mortgage, insurance, principal, interest, taxes, insurance, all that stuff. I mean, I understand why we have the stat of 18 million less buyers can afford. With all that being said, I saw something interesting this morning that talked about opportunity being right now for fatigued buyers who are still able to qualify and still in the market. There's going to be opportunity for them. No, that was PITI, Peter. That was all in. Principal and interest was about $2,850, $199 in mortgage insurance, $547 in taxes, $83 in homeowners. So that $3,681 was all in PITI. Obviously, yes, you could put 5% down, 10% down, 20% down, but not everybody has it. I think the average down payment for a first-time home buyer last I saw was 6%-ish, right? So I can tell you, and the data supports it, not everybody who's buying their first house has 20% down payment. Hey, Al, mortgage apps, surprisingly, last Wednesday, the Mortgage Bankers Association comes out with these stats every Wednesday. Last Wednesday, we saw uptick in mortgage applications. Interesting thing from the ground level, from my perspective, mortgage applications being up doesn't necessarily mean that you could call it demand, right? But if more and more people get themselves pre-approved or find out they don't qualify or find out they just don't want this $3,700 a month payment, those folks aren't real demand, right? So it might be one of those jumping off the fence, hey, I got to get in before rates go up even higher, before prices go up any higher. But the mortgage apps were actually up, especially on purchase. Refinance, we can all agree, and I talked to somebody this morning, it doesn't make sense for the vast majority of folks. If you've got a life event that requires you refinance, you might be refinancing up to 5.5%, but people aren't refinancing to, lower the rate and term like they were before. All right. A quick change in rates has led to a quick change in the market, and we're starting to see that in the stats much more right now. Yeah, and I think people are going to be real surprised, Ryan, with how quick it's changing, because, I talk to real estate agents every day that might have a little bit of head buried in the sand mentality where they don't really understand what's happening. Stuff that's being listed that would literally fly off the shelf 2 or 3 months ago, there's crickets. I talked to an agent the other day that said, I listed this place for $490. I haven't heard anything. Good neighborhood, good schools. It's priced well. A lot of people are just a little bit shell-shocked with the increase in rates, which leads to a higher payment, and they're a little bit frozen. That's my opinion as a mortgage broker who's talking to these people every day. They're a little bit hesitant. And sometimes when you're uncertain, you just freeze. There's a lot of investors that are going to use this time where there's a little bit of fear and uncertainty and use it as opportunity. Case in point, an investor I know who got a really good deal on a house because the investor who'd flipped the house was kind of panicked and wanted to unload it and really sold it for less than he had to because he was in a panicked hurry, right? Peter Bedford, 720 FICO. What is likely interest rate you could get on a 30-year fixed? Great question, and I can't necessarily quote rates or offer anything. I can just tell you I'm some dude on YouTube, and I'll tell you, it's going to vary if it's 5% down or if it's 25% down. But a lot of the stuff I'm seeing without any points attached is going to be mid fives. If you've got some money to buy the rate down, may or may not be a good idea based on your specific scenario. You could get that into the low fives or 4.99. I made a video about rate buy down. I think it makes sense for some folks. You might, in a market like this where things are changing and sellers are just awestruck because they have no offers yet, you might be able to go in there and offer a price, call it 500,000, ask the seller for 9,500 in seller credit. And if you're putting 5% down on that $500,000 house, that 475 loan amount, 2 points to buy down the rate would cost $9,500. Use the seller's money to buy down that rate, and you'll be able to get a rate with a 4 in front of it, which we wouldn't have thought 6 months ago that would be super exciting, but here we are. Okay, buy a home, 5% down, 720 credit score. I'm plugging in for you right now. This is not an offer to lend. NMLS number 1088993. Just going to give you a little bit of a range. If you weren't wanting to pay points, you would be somewhere in the neighborhood of 5.6. If, like we talked about, you had the ability to buy a couple points down, maybe get a seller credit to cover those points, like I kind of had thought in my head, you'd be able to get down to about 499. So that's where we're at today. All right, this is a question for Ryan. As an appraiser, how often are you seeing homes appraise under contract price? As a lender, I'm not seeing it a lot, really at all. Most of the appraisals I've seen have come in at value. I've actually surprisingly had 2 or 3 of them in the last week come in above value. $399 listing, got in contract for $350, appraised at $365. What else do we have? We had another one that was $10,000 above whatever our contract price was. 510 versus 500, something to that effect. So, yeah, let us know, Ryan, if you're seeing anything on your side. Oh, yeah, Ryan's fancy now. He only does the private appraisals. So he doesn't do the ones with the purchase contracts. But yeah, to Ryan's point, like as we're in a changing market, somebody lists for 600, and the thing about it is like appraisals are based on comps, and right now we've got a bunch of like high comps, in my opinion, from February, March, and April. So you get in contract in June, it's more likely it's going to price above value, in my humble opinion, based on what I'm seeing, because you've got these higher comps in a market where people were willing to pay 30, 40, 50,000, 100,000 above ask, no matter what it appraised at. Now those are comps. Now someone's not willing to pay that much above what someone's asking. And so it might end up coming in the other way. I don't know. Maybe you got some other views on that, Ryan. Even if you disagree, that'd be cool to hear your opinion on that one. I like how you put this, Marco. Southwest Florida market has increased price drops, 5 to 10% off on wish price listings, but still price reductions are happening little by little. And that's the perfect way to put it. Some people have wish price listings where if anybody who understands the market and is paying attention sees that price, they go, what the heck is going on? But to that seller and to that agent, maybe to some buyers, it seems rational. Those folks that are paying attention are like, nothing is sold over 600 in this neighborhood. and you think that in this market where we've got waning buyer demand, you're going to list this at 650, you're out of your mind. So yeah, some wish price listings, which is a function of a changing market. Not everybody is in it all day, every day, and really knows the true temperature of the market. And hence you see stuff like the stuff I see where an agent lists a home, they get the address wrong. They call it a multifamily instead of a single family. They use a picture off of Google Maps and they price it at 630. It's got no chance of selling. You know you're dealing with an amateur when you see that kind of stuff. Don't worry, realtors. The great ones I work with, you guys don't do any of this stuff, so you got nothing to worry about. And they never talk bad about you. But not all of them out there are crushing it. This is a good one. Where did I see this about home builders? Have you seen this hitting local home builders? There was an article today about Lennar, who's a pretty big home builder, does quite a bit of stuff out here in California. They've started trimming prices. They've started offering buyer incentives, which is, how the turntables, right? Like they were literally in a position where they had all the leverage in the world. And if you were buying a new home, non-refundable deposit, you had to bend over backwards and, get in 9 months before the place was built and all that other stuff. Rising rates, not as many, buyers walking through their new builds and putting in offers. And some people, I would imagine, are canceling because rates went up and they no longer qualify. So, Lennar, who's, delivering thousands of homes, is starting to trim prices. Let's see what they said here. The executive chairman of Lennar Homes said it's a complicated moment in the market, which is true, right? I mean, I don't want to talk smack about builders, although I got some, issues with some of their business practices. Like, it's a scary spot to be in. A lot of this stuff half built and whatnot, and seeing demand pause or demand slow down. 7 regions that they mentioned slowdowns, and this is Lennar, who builds across the country: Raleigh, North Carolina, Minnesota, Austin, Texas, Los Angeles, the Central Valley, and Sacramento in California, and Seattle. Yeah, they're in Sacramento, and I think I saw something about what they were doing in Sacramento. They are offering mortgage rate buy downs. So like I talked about in my buy downs video, you go and look at a home and you're like, listen, I don't know if I want to pay $650 for this new build. Lennar might say, well, check this out. We can give you $10,000 in credit. You'll be able to buy your rate down to 4.875. And that might be a payment that you're comfortable with versus, 5.5 or whatever it would be without the buy down. Could be something to consider. Home builders are facing rough seas ahead. I'll put the link to this article in the comments, so I don't have to sit here and read it. You guys can read it at your own leisure. It's a pretty good one. Kyle in PA. Thank you for asking this question, Kyle, because I have this conversation literally every single day. Would it make sense to take a slightly higher rate right now to lower closing costs as low as possible, with the idea that whenever rates go back to under 4% refinancing? While I agree that this could be a great strategy, what I want to warn people against is there's no guarantee that rates go down. There's no guarantee on when they go down and if they go down. So you just have to be comfortable with whatever mortgage you put yourself in. And I think that's something that I'm really straightforward with all the clients I talk to. I don't want to sell you, and this is what happened in 05, 06, 07, is, hey, you're going to be an adjustable rate mortgage. the payment's this, it goes up to this, it can go up to that, but don't worry, you can always refinance it. Like, I just think it's a bad mentality and bad way to look at it. I prefer to say, hey, let's structure this mortgage in a way where it's a good long-term mortgage in case rates don't go down and you end up staying in this mortgage, but let's not pay too much up front to where you're going to be disincentivized to refinance, or all this sunk cost is in this mortgage and it's kind of lost if in 18 months from now you can get yourself into a 4.125 or a 3.75. The Fed and our buddy Jerome Powell literally spoke about a U-turn, right? Talked about, I mean, I think it's in their projections that they're going to get the Fed funds rate to 3.4 and then 3.6. And then they had a further projection of like 3.2 or maybe under 3. Like, that's signaling, hey, we're going to jack up the Fed funds rate. We're going to slow down inflation. We might overcorrect it. When we do, we're going to make a U-turn. And that's going to pull interest rates back down. That's literally in their projections. And so smart folks in the mortgage space are talking about mortgage rates being lower in the future. I just don't think I wouldn't overdo it, right? I wouldn't go and take a 6.25 and get credit with the plan like, hey, I've got to refinance for this to make sense for my budget. I would just take something in between. You know, there's some pretty attractive mortgage rates right now in the broker channel. We got a little bit of price wars going on where I compare to some lenders I know where I'm like, holy crap, you guys are 6.25, 6.375. Like I did on that 720 score. That's 5.6. Get you better terms than that, even without any points at all, if your credit score is 740 or higher, or you're putting bigger down payment down. So, you know, you can still get in the mid 5s, pay next to nothing in points. I view it a little bit different in the points paying, you know, when it's somebody else's money, right? If it's a seller paying, then, you know, maybe it's a set it and forget it, put yourself in a 4.75 and forget about it. Also on the investment stuff, I think that's usually a lot more of a set it and forget it, because those get refinanced less often than your primary residence. So anyhow, that is that. All right. I didn't see Ryan answer this, so I will answer it for him. What is a private appraisal? It's just a private party, Al. There might not be a transaction, but somebody contacts Ryan and says, hey, we're, you know, dividing an estate and I want to get an appraisal of this property. Come out and appraise it. Let me know what it's worth. Or, you know, somebody's going through a divorce and they want to get a private appraisal done. They call Ryan. Basically, it's not, you know, lenders like myself and Ryan sitting on, you know, an appraisal panel where he's picking up jobs that way. He's got enough of a network, enough of a reputation where he just gets called, hey, we'd like you to come appraise this property and that property. He enjoys doing that instead of sitting on, you know, appraisal management companies panels and taking appraisals that way. Oh, this is a great question. We got to have Ryan back on here. Ryan, all these questions are directed at you, man. People want to know about appraisals. So everybody in the comments got to tell Ryan how much they want him on. Next Monday's 4th of July, so that's a no-go. But if you want to do the 11th or the 18th, Ryan, you let me know. You're always in high demand, man. People always want to hear from you. And I'd be interested to hear this too. Comps are backward looking, but how much influence does a cooling market looking forward affect the appraisal? I don't know the answer to this, Peter, so I won't try to answer it on his behalf. But when we were heating up, you could see comps at 510, 520, 530. Maybe the appraiser could justify appraising this one at 540. Does it work the same going the other way around, Ryan, where the appraiser has to take into consideration that something might have sold for 640 and then another comp sold for 630? And so this one, they start leaning into 620. Great question, Peter. Hey, Kyle, are all mortgages repackaged and resold still? Are there no credit unions or other lenders that will portfolio the loan and are willing to work with a buyer that doesn't meet the conventional rules? There's more of these lenders than ever before that do quote unquote portfolio loans, non-QM loans. These loans are all over the place. If you don't meet the conventional rules, you should expect to pay a higher interest rate. You should expect to probably pay, points and fees. Just the nature of the beast. They're taking on a little bit more risk. They can't package it up and just sell it to Fannie or Freddie. But there's definitely plenty of that stuff out there. There's a loan where you take the last 12 months of your bank statements if you're self-employed and you use that as income. There's debt service coverage ratio loans where you're buying an investment property. It's based on the debt service versus what the rent is, all that kind of good stuff. So plenty of stuff out there. Lennar is so greedy. In Fresno, they're auctioning off new build lots every weekend. So meaning they had lots that they hadn't developed yet that they were just auctioning off. I'd love to hear more. Maybe they were auctioning, expand on that, Adrian, because this was like they were selling the lots or they were making people auction and bid on the lot that they wanted in a new development. Sounds like you went with a different builder, but interested to hear more of that story. It's interesting stuff. Is there still a premium that the buyer has to pay for the higher balance of conventional financing? Yes, Al. And what Fannie and Freddie said and what they've done, and I've heard it out of everyone's mouth, it's absolute, how things are being done in their world. Second homes, investment homes, high balance conventional loans all have an extra premium, meaning the rate is slightly higher, more cost for the same rate for those loan level price adjustments, they call them. That money, extra money that's being made through those programs and charging a higher premium there is going to be funneled into first-time home buyer programs, different things that are going to help low to moderate income borrowers. That's their plan. They've made it pretty clear. So we'll see more and more programs aimed at low to moderate income borrowers. The problem with it is, if you're low to moderate income and a price in a home in your neighborhood cost $500,000, do you have enough income to qualify for a $3,500 a month mortgage payment with 3% down? That therein lies the problem. Raymond Cisneros Cruz. Thanks for asking this question. This is a popular one too. I wonder if I have a video on departing residence income. I'm going to leave myself a note because I should have a video on this and maybe I don't. You're going to buy a new primary residence. So the house you're in right now is your departing residence and you're going to turn it into a rental property. If you need the income from that rental or from that property you're departing to offset the mortgage so that you qualify, because everything's based on debt to income, right? Your current mortgage is $2,000. Your new mortgage is $3,000. Your job pays you this much. You got a car payment and some student loans. If all those debt payments versus that income doesn't fall under 50%, whatever the program is you're using, and you wouldn't qualify to buy. When you're departing a residence that's going to be a rental, you can get a lease. States Johnny Walker is going to rent this house for $2,500 a month. The lender's going to use 75% of that lease number. So they're going to take $2,500. They're going to times it by 0.75%, $1,875. That mortgage payment is $2,000, $1,875 in the rents that they can use. It's just going to be a negative $125 versus having to hit you with that whole $2,000 a month mortgage payment. So going to help you qualify. And yes, you do need a lease agreement. That was my long-winded way to answer it. But your question, do I need to have a lease? Yes, if you need that income to qualify, or you need that debt of that home offset by income to qualify. I received closing cost and rate buy down from Lennar in Menifee, California. Niner gang, When did you get that? I'd be interested to hear. My guess is it was recent. If they did it last year or the year before, then it might have been one of those deals where they juice you up and they give you the closing cost credit to use their in-house lender, which is a pretty sweet secret they use. Oh man, let me speak on this, Jessica, because I like this. I don't mean to laugh at folks, but it's funny, right? And Jessica, let me clarify. I'm not laughing at you. I'm laughing at the agent on this deal. They lowered it from 529 to 525. Come on. Like, what is that doing? You lowered it less than 1%. Just because they did this little lowering that wasn't really a lower would give me the green light to go offer 490. I would offer him 490. I don't think it's offensive. I think that it's probably a good starting point. If it's been on the market for 2 weeks, they don't have any action. They lowered it at 525, which may mean the seller is a little bit unrealistic, because as an agent, you're like, hey, listen, let's move this thing. Let's lower this from 529. We're not getting any action. Let's go to 509 or 515. 525? You're going down $4,000? Agents, if any agents are listening, like, tell me if there's some benefit to doing that, right? Like maybe it puts it up higher in the feed on MLS or something. Does it do that when you only lower it by 4,000? Because 4,000 is nothing, right? 529 and 525 are like the same number in my head. I wouldn't offer him 490, Jessica. Best of luck to you. That Bravo guy. This is probably the best question we've got so far. Should I ditch my credit union and use you? Of course you should. Seems like no one wants to accept an offer. They'll take 30 days to close. Depending on the market, some markets will. But as a mortgage broker, I'm probably better priced than the credit union. Lower rate, lower fees. And I'll close. Let's write a 21-day contract. Let's do it. GreatMortgageBroker.com. Fill out the form. When Connor calls you, say, hey, Connor, I was on the live. I was talking to Matt. He said you guys are going to give me a smoking deal. What's up? Let's do it. We'll get you pre-approved. We will connect with your agent. Tell them to write a 21-day offer. I'll call the list side personally. I'll schmooze them, and we'll get them to accept your offer, and you'll be off and running. So that Bravo guy. I'm going to look for an application with the last name Bravo. Juan Bravo. That's my guess. Final answer. All right. So Lennar released 2 lots every couple weeks. They would have an auction with the predetermined new build home that went to the highest bidder. I mean, it's all supply and demand, and they kind of could make the rules, right? So I don't know how common that was with new builders, but certainly not against the rules. Certainly something they could do and did do. So, yeah, I actually think I heard about a lot of this stuff in like Vegas and other markets where they were doing auctions, right? I was actually surprised they didn't do more of that. With as much demand as there was, like locking somebody up at 620 and then having all these phases go for 650, 680, 700. It's like, shoot, this guy who was locked in at 620 was feeling really, really good until rates ticked up. Then he felt bad. Joey Garessi, what's up, brother? Smash the like button, y'all. Joey once told me if you guys smash the like button enough, the Kings might make the playoffs next year. That's what he said. I don't know if it's true or not. I like our new guy, Joey. So we got a new coach. We got Murray in there in the number 4 draft pick. Might be the 7 seed this year. I'm calling it right now. 7 seed in the West. Sacramento Kings. Let's go. This is some good advice from Peter to you, Jessica, about that 490 offer. If you or your agent has access to look at how much equity the person has, different sellers have different amount of motivation. And, in that case, a house me and my wife bought last August, the couple was in their 90s and they had a house that was free and clear. The offer that I made was probably similar to your scenario right now. $495, and they were listed higher than that, but it was free and clear. So like $495, $510, $515, like it's all the same. They get about $500,000, and they have no debt, right? So I agree with this advice. And truth be told, Jessica, I don't think you have much to lose by throwing a $490 offer at them. Will they say no? It's if you don't try, you wouldn't know. I mean, offering $400 would be laughable, right? But $490, you're in the ballpark. You're only, what's that, 6% below list or something? Fired off. Matt Bittner, the rate question: what shall happen with interest rates? Man, every single person that had interest rate projections for 2022 were wrong, myself included. And so I wonder if I should even try. I think a lot of the stuff is baked in, right? A lot of those rate hikes are expected. So the Fed raising the Fed funds rate is no surprise to the market. Mortgage bonds shouldn't really react because they should expect it. I feel like rates could go higher after, when was it? 17th and the 24th, we had really volatile days. No, 17th and 20th. Were those the nasty days? Or was it the week before? Maybe it was the 10th and the 14th. 10, 11, 12, 13. Whenever it was, earlier this month, we saw some nasty. Now we're back to, we had a good week last week. And we're back with a 5 handle on the 30-year fixed. I think things remain rather calm and probably stay within this 5.5 to 6.5 range over Q3. It's my best guess. All right, June 3rd, 2022. You got some closing cost credit and some rate buy down from the builder. Congrats on the closing, Niner gang. Congrats on being a Niners fan. That's good too. I always give Niner fans better deals than Raiders fans, just as a general practice. Just kidding. I can't do that. Joe does mortgages. The next question is key. And I can't find the second half of it. Joe, where'd you go? Joey Garessi. Thanks, brother. I'm going to keep doing it too. I really enjoy this stuff. So the lives, we shall continue. Weekly 2 or 3, educational posts, we shall continue. I've got some cool stuff in the works too. I've got a home buyer course I recorded, which I'm practically giving away for free, but we're going to get together internally at UMortgage, make a really, really good home buying course. And I've got some sort of plans for it. I think it's going to be, $99-ish. And then folks that get pre-approved or work with us, no matter what state you're in, of the 48 states we're licensed in, I'm going to give it away for free. ZZV, is there a cap to the number of points you can buy down? Yes, there is. And I wonder if I could pull up what I should do. I should pull up a rate sheet just so you can see. One, it's not going to make a lot of sense to pay 5 or 6 points, but 2, it won't pass QM, qualified mortgage. On primary residence, you probably run into that QM issue at about 3 points being paid. A little bit more leeway on an investment property where I think I've got one right now where somebody's paying 4 points, and it's literally like a set it and forget it, almost an insurance policy for this investor, which makes sense for their specific scenario. So yeah, you're going to be capped at 3 or 4 points, even though the rate sheet was going to show me what I can get if I paid 7 points. It's a law of diminishing returns to where like once you get past 3, it doesn't make a lot of sense mathematically anyway. So there's that. All right. Would I need the deposit money and first month's rent to start pre-qualifying, or just the lease? Just the lease on most programs, Raymond. I ran into it recently on a jumbo loan where they wanted that deposit and proof that it was actually deposited in the person's bank account. But for most conventional deals, all you need is that lease. With that lease in place, as long as it's within range of what that place would rent for, lender's going to take that in order to offset the residence that you are departing. So good question. All right. New home builder offer me 5.875 with a 9.5 credit for 10 years with a 17.5% down. Omni Trader, you got to tell me, is this a 30-year fixed, or is this for 10 years? Is this like a 10-year arm? And why would you put 17.5% down instead of 20? And how big is the loan amount? And how much is the purchase price? And what is your credit? A lot of things to consider here. Maybe a good deal. It may not. If it's a 10-year arm, yeah, give me some deets. I'll give you some honest feedback. All right. Now you got the questions that at the end of a Monday will make my head hurt. What do you think corporate bond defaults could do to housing? Large companies are going to be forced to pay higher rates, and that could create negative cash flows. I mean, no doubt we're headed into recession, right? And money being more expensive hurts corporations. We've seen what happened to the stock market. Truth be told, I don't know how much this affects housing, except for its further drag on demand, right? If corporations suffer, they start doing things like layoffs. That affects the folks that are qualifying to buy homes, right? And I think something that people haven't talked about a lot is the, psychology or whatnot behind like housing, buyer sentiment specifically, right? Stock market starts to go down. Buyer sentiment suffers because people are like, oh, I just lost 30% in my stock portfolio. I'm not feeling good about the future of my job. I'm not going to go buy a house. Like those are the things that pull down demand. Ultimately, like I look at the supply versus demand to keep it simple. And the things that affect that, less jobs, less bullish buyer sentiment and whatnot. So it could have an effect. It's not a super direct effect, but that's the best I got for that one right now. All right, where do we go? Did California already do this? Oh my gosh. I probably shouldn't even start to talk about this. California is literally doing an inflation stimulus where people who make up to $500,000 are going to get stimulus. We know stimulus caused inflation. We know inflation's a problem. Let's try some more stimulus. I don't know. I probably shouldn't say anything more on it because it's just... Say a prayer for us in California. I haven't, Kyle, seen this, the EIDL. I haven't seen it show up on a credit report. I don't think it does. I think those are more like business loans. that wouldn't necessarily be tied to like your business and not necessarily show up on your personal credit. What I would say to be careful for is I've seen PPP and other stuff show up in self-employed borrowers' balance sheets. And then when we get into underwriting, especially on a jumbo loan where they're really digging through, they're saying, hey, your business made this last year, this the year before, but you got $180,000 influx of PPP. Is your business as healthy as it looks on paper? Knowing that like that is something that you're not going to get in future years. So I will beware of that. Our new build is set to close in August. We signed the contract 14 months ago. Since then, interest rates have more than doubled. Can we ask the builder to compensate us since costs have gone up? I mean, I guess it wouldn't hurt to ask. I think it probably depends on the builder. It probably depends on how much demand they have for the house. Unfortunately, if you're in contract at 680 and they could sell the house for 730, and you're like, listen, rates have gone up, and I got into contract at 3% and thinking that I was gonna be able to get this. So can we lower it from 680 to 650? From a business perspective, they're just gonna say no. We'll break the contract and go sell it for 730. Unfortunately, might not be much you can do. A lot of those deposits, I think, are non-refundable. And so I don't even know how you could wiggle out of that. But I would, at the very least, see what they can do. Maybe out of the kindness of their hearts, they're going to give you $10,000, $12,000, $15,000 credit to buy that rate down, at least get you, in the mid fours. Know too that 73% of buyers that buy new builds use an outside lender. That number is significant because I know how much lenders steer buyers to use their in-house lender. If 73% of people are using the lender that's not in-house, that means that probably 90% of the time there's a better deal to be had elsewhere, i.e. a broker like Matt the Mortgage Guy. Go to greatmortgagebroker.com, fill out the form, let us know where you're at, where that new build is, and show us the loan estimate from those suckers, and we'll see if we can smash them, offer you a better deal, and help you negotiate in the process. All right. I like those little pitches. It's just fun sometimes. Joey Garessi, most conventional loans, 3% is the max. 3% of the purchase price. So cool thing about investment properties is, you might be putting 20 or 25% down. So you buy for 500, you're putting 20% down. So you're only financing 400. You still get 15,000 in credit, 3% of the purchase price, which is, a 3-point buy down plus some extra juice. 3.75. Is that what that is? 15,000 divided by 400, 3.75. I still got it, guys. My math. I may be old. I may not be able to spell everything correctly, but I said my math game, still sharp. All right. OmniTrader was 30-year fixed. You answered one of the 7 variables, but I like you. There you go. There's the rest of them. 450, 30-year fixed. Why 18%? It's okay. 450. You realize you're going to be paying mortgage insurance. Most companies are going to make you pay it for 2 years minimum because of that 2%. That $9,000 in credit, use that to make your down payment 20%. Feel me? That's what I think. We're licensed in Texas too. I'll hook you up with Connor. Credit is 800 plus. All right, let me see if this is a sweet deal for you. 9,500 in credit. That's pretty good. 18% down. I wonder what the mortgage insurance is too, because that varies from lender to lender. So I would get some clarity on that. I would get some clarity on. All right, 5.875. Mortgage insurance should be cheap, like $31 a month. $9,500 in credit for that little loan. That's a lot. It's like 2.5 points. Pretty sweet deal. Pretty sweet deal. Get it in the loan estimate so we can really line it up and see what it is. Hey, what's up, Jose? I mean, Convoy's a broker just like we are, so they've got all the same products that we've got. I just don't sell the dream as much as they do, right? Where they're like, oh yeah, non-QM 5.99. Like in small writing, it's 9,000 points. I won't talk too bad about the kiddos, but yeah, you can certainly go get yourself a 40-year IO. IO for the first 10 years converts into a 30-year fixed. Bunch of different lenders offer that. And, you know, it's got the 3-year prepay, which is standard with non-QM. You can buy it down to 2 years. You can buy it down to a year. You can buy it out altogether if you wanted to. So you could refinance out of it whenever you wanted. But if you're going into it trying to do the IO to, you know, have better cash flow, whatever the reason is for wanting that IO product specifically, plenty of lenders that will do it. I know I'm doing one right now with Angel Oak. They had a special in June where there was no extra rate hit. You know, the regular DSCR would have one rate, and then if you're doing interest only 40-year, it would be a quarter higher. They were doing it at the same rate. So I actually think we were around 6%. Some cost up front. I'm honest about that. I'm not trying to sell anybody anything, and make believe that like non-QM loans have a better rate than investment property loans that are conventional. Just not my cup of tea to overpromise and underdeliver. But anyhow, I'd look into it. I'd weigh the 40-year IO versus the 30-year. I think the best advice that I've seen on this type of stuff is don't like take a deal that may not be a deal and massage it into something just to make it a deal. You know what I'm saying? If on paper an investment property doesn't make sense in a 30-year fixed, I don't know if you necessarily go into a 40-year IO just to make it pencil, because I think there's going to be plenty of deals to be had the second half of 2022 where you don't have to do that. So that's my best advice on that. Hi, Matt. How does subject to affect the seller's DTI? How does seller qualify for another home? They are likely going to be in a position where that mortgage that they're letting somebody else take over subject to is going to hit their DTI. There's no way to get around it. Like, in order to omit a mortgage payment, you have to show 12 months of somebody else making the payment. Sorry, I started squirrel. So it's likely to affect him, and there wouldn't be any way to really get around it. I need my capital for day trading, hence the name. All right, PMI is $31. I mean, if you're going to do 18% down, you might as well do 15%, because you know the PMI is going to be the same at 15, 18, and then you know the 10K for day trading. Save another 10K and put 16% down. They wanted 1% of home down for that 5.875 rate for a 90-day lock. 9K in credit, but with that 90 days, 1% lock. I mean, on the surface, everything you've told me, I think that's a pretty good deal. And yeah, when I see a good deal, I tell you it's a good deal. So if all that stuff is true, then you're in a good spot. What you can do, and what I always suggest people do, you're going to get a loan estimate from the builder, send it to a mortgage broker you like and trust. I got to set up a separate email so you don't have to go through the trouble of greatmortgagebroker.com. Yeah, if you've got something like that, where it's just, hey, here's a loan estimate, take a look, send it to team@mtmg.com, and we'll take a look at it for LE review. I'll have my team take a look at it. Andrew Paolo, thank you. I appreciate the kind words. I enjoy coming on here every week. I enjoy creating the content. And so come back, bring your friends, share the videos. If you are new to the channel, know that there's 600 plus videos. If you've got a question like how do escrow accounts work, type in escrow accounts, Matt the Mortgage Guy. Should I buy points? Matt the Mortgage Guy. Rate buy down strategy, Matt the Mortgage Guy. Type in like the question you have and my name in the YouTube search, and there's a good chance that I've made a video on it. I've made a video on a lot of different things, restricted stock unit income and how that works, self-employed borrowers, DSCR loans, bank statement loans, all kinds of different stuff. If there's something that you don't find and you have a question, I wrote down departing residence income because I'm not sure if I have a video on it, but if I don't, I'm going to make one. Slowly but surely, I will have a library of a couple thousand videos, and you will just be able to search there and find your question. As guidelines change or as things change, I update some of these things. Pros and cons of a cash out refinance was a great video that got 100,000 views. So I went in and updated it with some new information, a newer, smarter me, and all that good stuff, right? And probably, truth be told, I'll be going in there and finding some of my old stuff that has good information that just may need a little refresh. So thanks for watching. I appreciate it. And, that's my hour for today. I've got some work to do. We're in a changing market. Pay attention. I won't be on next week. Maybe I'll do a surprise live sometime during the week, but barring holiday like it is next week, every Monday at 3 p.m. Pacific Standard Time, you can find me here. Shoot comments in the YouTube section, and I try to look at all those and get back to all those. If there's an idea, something you want to see, I'm happy to do it. If you want to connect with me and my team, one last shout out, greatmortgagebroker.com. Fill out the form. Let us know where you're at. We'll be happy to help. Until next time, folks, we gonna see.